today's question is kind of an interesting one. It says bridge loan. They've heard about. It says I've heard the term bridge loan, but can't imagine it's a loan to buy a bridge. Art, what sort of loan is it, and what is it used for?
Yeah, that's a funny one because sometimes I'll get in conversations with people about bridge loans and tell them, hey, if anyone's trying to sell you a bridge or has a bridge to sell you, then I can help you with a bridge loan, which of course is a joke, folks. A bridge loan, though, I did want to talk about. It's a good question. I think there's not a lot of understanding of how it works. So I wanted to go over that. A bridge loan is basically a specialized product that, as the old saying goes, allows you to kind of have your cake and eat it too. And what I mean by that is you're a homeowner currently. You own a home that maybe has a lot of equity or might be free and clear. And you're looking to buy another home, and given where your market is and what your market is doing in terms of activity, you may have a need to try to acquire that home you want to buy and do so without the contingency of getting your existing home sold, even though that is your intent. You don't want to keep your current home, but at the same time, so you're going to sell it, but at the same time, you want to buy that other home and buy that now without getting that current home sold. And the bridge loan really is a product that serves that scenario where the homeowner of the current home who now wants to buy another home doesn't have adequate income to meet a debt ratio to be able to complete the purchase transaction while carrying the expense of the existing home. Even without a mortgage, we still have to carry the expense of taxes and insurance and HOA dues when you're trying to buy another home without having that existing home sold. So a bridge loan solves that problem. And basically the way it works is, and I've got one going right now. In fact, I'll use that as an example. I've got a client who owns a home currently, and it's worth about $1.1 million. They're going to list it for about $1.1 million. And they owe about $400,000 on the first mortgage. They're looking at downsizing. They're going to buy a home for about $680,000. So it's definitely a downsizing situation. But they want to complete that purchase while they're getting their existing home sold. And the bridge loan will allow them to do that. So in this particular case, the bridge loan is going to be able to be enough to cover the entire purchase price of the home being purchased. So in other words, we're going to be able to arrange a $680,000 loan amount that'll be used to purchase that home for $680,000. That bridge loan for $680,000 will actually, in this scenario, be what they call cross collateralized between the two properties. In other words, on the home they're selling, which has $400,000 owed on it, listing it for $1.1 million, a portion of the $680,000 bridge loan will be secured by the home being sold. And in fact, that piece can go up to 75% of that list price when added to that existing $400,000 first. So then the rest of the $680,000 bridge loan is then secured by the home being purchased. So if you think about it, folks, if you're buying a home for $680,000 and you're able to get a bridge loan for $680,000 because you're splitting that loan into being secured by both properties, you're actually getting 100% financing. So this is actually an example of how a bridge loan, along with a VA and a USDA loan, is or can be, in certain circumstances, a loan that provides you 100% financing for your purchase. Now, what you cannot finance is the closing costs. And the closing costs on bridge loans are not low. I mean, closing costs are high. Bridge loans generally are short term. They're typically 11 months, oftentimes provided by private money lenders. The interest rate is going to be high, generally around 10 to 11%. Mortgage payments are interest only. And the payments are only hopefully going to be made for a few months, literally 1 or 2 months, maybe 3 or 4. The whole idea is once you sell that home that you're departing from, then that will allow you to then get that bridge loan paid off. And therefore, you're only going to be making payments maybe, again, from 2 to 6 months, maybe more. That's why the term is set up for 11 months to allow you enough time to sell. So for that, few months, yes, you're making an interest-only payment on what is considered a relatively high rate. Closing costs are also higher than typically than conforming loans. With these types of bridge loans, you're looking at probably 2 to 3 points plus some lender fees. So it is considered a higher cost mortgage. But if you think about it, the lender really isn't going to make much money on the transaction just from the interest rate for a few months. There's not enough return there. So they have to essentially front load their return for giving you this vehicle to, again, as I say, have your cake and eat it too, and get that purchase done while you're simultaneously getting your existing home sold. So for the right circumstance and for the right borrower, sophisticated borrowers in particular understand how effective this can be, because you're able to complete the purchase with really even with the high closing costs, really very little money out of pocket. And again, have that ability to close quickly while it may take you a few months to get your existing home sold. In this particular example I just described, the borrower's contribution to the entire transaction is going to be about $30,000. When you consider a $680 purchase price and you're only out of pocket $30,000, that's a pretty good outcome. And it's going to allow them to achieve their goals to get into this other home that they're downsizing sooner than later. So that's basically, Jeff, how our bridge loan works. It's a good product for the right situation.
Just one follow-up question. So you said this is designed to be a short term. So then within that time, so let's say in your case, your case study is they sell their home, and now do they pay off the other loan, or do they now refinance it and get a long-term financing on that? How does that work? Or does that give them the choice?
It'll be a choice depending on the particular borrowers involved. In this case, what will happen is when they sell their existing home, their departing residence, we call it, that's obviously going to pay off the portion of the bridge loan that was secured by that home. And it's around $350,000. So then the remaining portion that's secured by the home they bought, that by the time they sell their current home, they're probably already living in the new home. So when the old home is sold, that portion of the that portion of the bridge loan is paid off. And then the rest of the proceeds from the sale will then be applied toward payoff of the portion of the bridge loan on the home that they bought that they're now occupying. In some cases, the remaining sale proceeds will not be enough to completely pay off that other bridge loan piece on the home they bought. So they may have to contribute some of their liquid assets to complete that payoff shortfall for that piece. And in this case, my clients do have that money to do that. Although ultimately, we're going to look at giving them a refi on the purchase home so that they basically can get some of their cash back and use that for other purposes. So,
in that situation, as the homeowner who's using that bridge loan, let's say that the time lapsed is 120 days. It falls short of that 210 you talked about earlier about streamlining. Does that hurt them, or are there pieces you have in place to make that transition easy if they have to go to a new loan?
Now, are you still talking about the bridge loan scenario?
Yeah. So they still have money they owe on the bridge loan, but they have to they have to replace that in a period of time, right?
Well, yeah, but keep in mind the 210 rule, that does not apply to a bridge loan situation where you're going to refinance at the end of the sale of your existing departing residence and refinance your purchase property if you need to in order to pay off that piece of the bridge loan. The 210 rule doesn't apply. The 210 rule is specific to FHA Streamlines and VA IRRRLs, an entirely different product.
Gotcha.
Yeah.
Gotcha. Well, again, this seems like a great opportunity if you're thinking about, you found a place, or maybe you've had to move, or in this case, downsize. It's your choice. And you found that perfect scenario, but your home you're living in is not sold yet. It sounds like the bridge loan is actually not a bridge to nowhere, but a bridge to your new somewhere.
That's true. And particularly in this environment, as things getting more optimistic, rates have settled down a little bit. There does seem to be more activity going on in terms of people getting out there looking at homes and wanting to get pre-qualified. What that's going to happen is bring back where we were not too long ago, where sellers are going to be hesitant to accept or consider even any contingent offers. Mm-hmm. So if you're in that predicament where you see a house you want, but you got a house to sell, if you got the equity sufficient to do so, a bridge loan is a great